Are you investment curious? Thinking about investing your money but don't know where to start? Are you a business owner stacking cash but don't want to invest? Or maybe you just inherited a brick of bills and you'd like to grow it into a fortune? On this episode of Through the Pines, we'll walk you through how to invest, including financial planning versus investing. What are the differences? When to start? Hint now, how much to invest, opening an investment account, choosing an investment strategy, what are the investment vehicle options you should consider, why you should use a professional, and investing with big money. So welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while picking up pine cones. This is Through the Pines. Our advisor, back with just the one, Rex, for this episode. Rex Baxter with planwithbaxter.com. We're missing Brandyn again for this one, Rex.
Yeah, he's sick and getting taken care of by Sasquatch. And okay. So Sasquatch playing nursemaid, and
right.
And so hopefully he gets back with us soon. He makes the podcast just a lot more fun.
Love having Brandyn here. We just have Rex, and we'll get right to the point on this one. So Rex's group 2023 and 2024 Forbes Best In-State Wealth Management Team for Utah, as well as Advisor Hub's fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Clients Experience Award, which tells me, Rex, you know a thing or two about financial investing.
I know one or two or maybe three things about investing over these years. So thanks for having me. I appreciate it.
Let's dive into how to invest. I mean, this is like you think this is basic, but some people don't know how to invest. Let's start with sort of defining it. And what is the difference between investing and financial planning?
So let's define the difference between those two things, then we can talk more about on the investing side. So financial planning is where you answer, I like to say where you answer all the difficult questions of life, financially speaking. Yeah. And so,
darn it, I thought we were really getting deep here.
I know we're getting to those religious meanings.
Yep.
No, so we answer when can I retire? Am I going to run out of money? When should I take Social Security? Can I afford to buy this house versus that house? What does my retirement spending look like? Those kinds of questions are the kinds of questions that we handle through the financial planning. And so we deal with net worth and cash flows, the commonality of returns over time, as well as the variability of returns over time, and the unknown of returns over time, the randomness. And that's a big deal, as well as we take into account inflation and taxes and tax code changes. All of those difficult types of variables and issues is what we handle in financial planning, which I think is extremely important. And most people, I believe, are significantly more successful financially if they have a plan, and a written plan, and a plan that they're going to try and follow and try and see through over their lifetime. Then those types of investors are significantly more successful.
Okay. And so investing is just putting it away, I guess.
And investing is exactly what it sounds like. It's the management of money. It's the buying of stocks or bonds or CDs or money markets or cash, and keeping it in different asset classes. Investing is trying to get a return on your money, is what investing is.
Okay. And it can be real estate, it can be businesses, it can be anything?
It could be real estate, it could be private equity, it could be hedge funds, it could be, in anything where we're trying to get a return on our money, then that's considered investing.
Okay, so if you are considering how to invest, when should you start?
Yesterday.
Yeah.
Right? Start yesterday.
Now. Okay.
Start now. Start immediately.
So what if you don't have a lot of money?
So if you don't have a lot of money, then there's an order that we want you to try and follow, right? We want to be focused on building up your emergency fund. And that normally a certain amount of that can go in your checking and savings accounts. And then we start looking at high yield money market accounts. But normally you build up your emergency fund to where we have 3 to 6 months of your savings. And then we can get to more aggressive types of investing, whether it be CDs, which doesn't sound aggressive, and it's not, but it's more aggressive than a checking account or a savings account. You can deal with bonds, whether it be government bonds, treasury bonds, corporate bonds, lots of different kinds of bonds. Or in the industry, we use jargon called fixed income, is what the industry refers to that as. Or we can get into equities, right, which is owning companies, owning stocks and individual companies or mutual funds or different kinds of investment pooled vehicles like mutual funds or unit investment trusts or exchange traded funds. There's a lot of different pools out there that group together different kinds of stocks or stocks and bonds. And that's where we get lost in the jargon a little bit. And that's where people start to get that glazed over look of, oh gosh, I want to start today, but that's too confusing. I'm going to throw my hands up and just not get started.
Yeah. Yeah. Okay. So how much should they invest? Like how much do you invest when you start investing?
So when you're just getting started, if you're younger, then you can start with fairly small amounts. You can start with maybe $100 or $1,000 or things like that. I think the more important piece is making it automatic, as my partner Brandon likes to say, but also making it, steady and consistent so that it happens every single month or every 2 weeks or whatever that time period is that you need. We'll get into investment vehicles, but you can start with fairly small amounts of money if that's where you need to start. If you come into an inheritance or you sell a business or you sell some real estate or your business has been cash heavy for a while and you've been building up significant cash, then obviously there's different investment vehicles that open up to you that we'll talk about as well. So it kind of depends on which end of that spectrum you're on as to what vehicles are going to be most appropriate for you at different times.
Okay. Interesting. All right. Opening an investment account. Like what's the first step? Can you just jump online? Do we call you? planwithbaxter.com? What's the first step in opening an investment account?
So part of that's going to depend on the amount of money that you're looking to start with.
Okay.
And so if you're young and you're starting out with the $100 a month, you want to make sure that the costs aren't going to eat up the return, right? And so if you open up an account and the account at an investment firm may have a $100 annual fee kind of issue, and you're investing $100 a month, right? That's a big fee. That's 100% the first month, right? Over the course of the first year, that's a 10% fee. That means the market or whatever you invest in has to go up 10% or more for you just to break even. And the odds of you being able to be successful that way is pretty slim. And so then you're going to have a negative experience your first time out, which could jade your entire investment experience over life. And we don't want that. We want you to have a good, positive initial investment experience. And so there are ways, if you're again, just starting out and starting with a smaller amount of money, there are ways to where you can invest directly with companies. You can, there's every public company has what's called a transfer agent. And that transfer agent is who does the accounting and the bookwork on those individual stock. They keep track of who owns the stock, how many shares they own, things like that. And so lots of times you can go to some of these transfer agents like Computer Share or Bank of New York Mellon, things like that, or a couple of the big ones out there. And you can invest directly into a number of public companies, whether it be a Coca-Cola, a Microsoft, a GE, you name it. But a lot of the big companies you can invest in directly. And typically there's a very minimal cost to do that if you're just getting started and you want that initial experience of just stocking away smaller amounts of money. Then sometimes you can do it that way, or you can do it with some mutual funds. There's still 1 or 2 mutual funds out there that allow you to go directly to the mutual fund company. And you can sometimes start with as little as $100. Most of the times it's $1,000 without an advisor.
Interesting.
Yeah. And so you can, most of them are $1,000 minimum. Sometimes you can start lower than that. But again, you really want to be careful on the fees on things, because if the fees are eating up all the return, then you should just save up in a high yield, money market or savings account until you hit 1,000 or 5,000 or 10 until you have enough money to where the fee is going to be, 2% or less of your investment money. And even at 2%, 2% is still a little bit on the high end. But if you're just getting started out, you may have to deal with being on the high end because you just don't have a lot of money yet. So,
okay. So what about if you have a lot of money to invest? What's the best way to start an account or open an account?
So most of the time, if you have a lot of money, and let's define a lot of money, right? Because that's going to be something different for everybody. And so for the sake of a lot of money, let's say $500,000 to $1 million or something like that, that you're trying to start, meaning that, and normally if you're coming into that kind of money, and you don't have any investment experience in the public markets, in the stock markets, things like that, typically it's coming from real estate, it's coming from an inheritance, it's coming from the sale of a business, something like that.
Mm-hmm.
And
A
so,
really good poker game.
yeah, you're really good poker game. Yeah, I was just in Vegas with the World Series of Poker, and
Oh, really?
those tables were full. So
Yeah,
somebody's
yeah.
coming away with something.
Yep.
So
That's
a
wild.
lot of people are coming away with nothing.
So side note, do you gamble?
Not frequently, but
Yeah.
on occasions, but not frequently.
Okay.
And so, but on occasions, I'll throw down here or there. And so
Okay.
I think you have to be careful and make sure, that's a very addictive thing that
Yeah.
you have to be careful of with people. But for entertainment purposes, I'll do it on occasions.
That's your fun money.
Yeah.
Entertainment.
It's absolutely some throwaway money for sure.
Okay. Yeah.
And so,
Okay.
hopefully I don't. Hopefully I walk back with it.
All right. So back to using or calling an advisor.
Yeah, so you probably ought to work with an advisor if you're dealing with larger sums of money,
Okay.
in my opinion. And so because typically if you're coming into that, it's normally not a passion of yours. You may not have the formal education in it. You may not have the 10, 20, 30, 40 years of experience in the markets that advisors are going to have.
Mm-hmm.
And in addition to that, you're probably going to want to complement the investings with the financial planning and do both, especially right out of the gate at the same time, to make sure that we're being efficient with your dollars and we're allocating them towards the goals that are most important to you.
Mm-hmm.
But on the investment end, when you start to get up into that $500,000 to $1 million, you're starting to open up a lot of different investment tools that are out there. And so, we can do separately managed accounts where we're hiring a premier investment manager if you want. We can look at numerous different mutual funds, index funds, exchange traded funds. These are all just pools of different stocks or stocks and bonds that are out there in the marketplace. And so, but you're going to want to work with an advisor to build out a portfolio that is appropriate for you based on your risk and time frame.
Okay. Very interesting. Again, we were talking with Rex Baxter, planwithbaxter.com for more information. Choosing an investment strategy. So sure, I want to talk strategy. Like, what is that? Short-term, long-term, retirement, aggressive, not aggressive?
All the above?
All of it?
Let's go
Okay.
with all the above.
Right on.
I like E. So
Yeah.
I like answer E. I think as far as investment strategy is concerned, you're looking for a number of different things. Most of the people will have different goals over time. I want to retire by 65 or 60 or whatever the age is. I want to be able to buy a boat when I'm 40. I want to be able to, buy this rental property. So I have additional income coming in from a rental property. And so as we start to map out what those goals are and the amount of capital that we need for each of those goals over time, that's going to start to drive how aggressive or conservative we need to be with your money to hit that goal. And that's going to, based on the aggressiveness of the portfolio, that's going to start to drive how much money we have in the stock market versus the bond markets or fixed income markets versus cash.
Mm-hmm.
And so then we're going to start to build that out. Again, we're building out the portfolios according to the goal and the time frame that you have. That's going to be critical with the advisor that you're working with. Sometimes you'll get advisors that believe all money should be all aggressive all the time because that's where you're going to get the best returns over time. And albeit, to a certain extent that is accurate, that is where you'll, over long periods of time, you should get the best rate of return. The downside of that is that if your goal happens in 5 years and we happen to have a significant market downturn in that 5-year period, then all of a sudden we're selling at a significantly depressed price and we're selling low. And that can be avoided through that diversification, through making sure that we're paying attention to the liquidity needs as well as the time frames that you're trying to invest in.
Okay. So strategies will be basically determined by your personal situation, I guess, and what you're trying to do.
Yeah, it shouldn't be determined by your neighbor.
Okay, yeah, but they may influence you, but don't let them, I guess. Is that?
Yeah,
okay.
All information is good information.
Yeah.
Right? So take it in, but also understand that you probably don't have all of the information, and so what they're doing may not necessarily be what you should be doing.
Got you. Okay. Then there are different vehicle options, and you did allude to this depending on the amount of money you have. Do you want to cover some basic vehicle options when learning how to invest?
Yeah. So when you're first starting to invest, a lot of times the first investment experience you're going to have, other than your checking and savings in a money market account, normally is going to be your retirement plan. Normally that'll be a 401k plan or a simple IRA or SEP or some kind of company-sponsored retirement plan. And inside of that, normally you're going to have about 20 different investment choices. And that can get really confusing your first time out.
Yeah.
And so what we see a lot of employees do is that's where they ask their neighbor, right? That's where they ask whoever they're working shoulder to shoulder with,
Yeah.
well, what are you doing?
Right.
And most 401k plans have a financial advisor assigned to them. Not all, but most do. And so normally you want to go to the financial advisor of that plan and say, hey, here are my facts and circumstances. Here's my personal financial situation. How should I be investing based upon those facts? And then they should guide and help put a portfolio together for you. The other question on that, on that first experience in retirement plans that you're going to get, and we've talked about this in other podcasts, is should I be on a Roth 401k or a traditional 401k? And so you have a lot of different questions coming at you when you just first start to get investing. And I think on the internet you can get some of the answers. Unfortunately, it's very generic advice typically, and so don't take it as that advice is perfect for you. It's just another piece of it. It's another data point. It's another piece of information that to where you need to understand the rules and how it works. And then you want to get the advice from an advisor as to, okay, is that right for me? Is it not right for me? And why? You want to know the why.
So if someone has money to invest and they are unsure about how much or the vehicle that they should put it in, at what point do they call an advisor like yourself? And do you charge when you pick up the phone? Like, how does it work?
Yeah. So luckily, most of us are not like some professions where it's the almighty billable hour.
Right.
Right. And so most of the time, your first.
That's the assumption, like I can't call a financial advisor because I have to pay them as soon as they answer the phone.
Yeah. I think the two major assumptions are, one, when I call them, it's going to be expensive and I have to pay them. And almost always that first conversation is free. It's complimentary, just to kind of get to know each other and get to know who you are and if we're a good fit, and to see if we can help you with what you're trying to get done. And that's very few advisors would try and charge on their first call. I think there's that piece of it. The other piece is that you should probably be calling us. If you can call us before the money is available, typically that's ideal, because that way we can get to know each other a little bit before it's actually there. You can interview a couple different advisors, and you can kind of go through that process without the pressure of the money sitting there weighing and feeling like it's burning a hole in your pocket, so to say. So I think if you can do it before, if you can't do it before, then do it as soon as you can and have those conversations.
Okay. But you don't charge when you pick up the phone.
We do not charge when we pick up the phone.
Okay.
That is accurate.
Okay. So investment vehicle options for those with a lot of money. So $500,000 to $1 million, and they're either inheriting it or they have it in a 401k that they just haven't paid attention to, and they open up a statement. They're like, oh, that's a lot of money. I should do something with this. Yeah.
I think it's always interesting. I'll use an example here, but just the other day, we had I was sitting in a dance competition. I know that's shocking to our audience.
Yes, I love it.
But and somebody had come up to me and said, hey, what do you think about private equity? And this is somebody I'd never talked investing before, right? And things like that. And so I was like, well, it depends.
No one's asked me that.
Really? Yeah. So I must have been wearing the wrong, my Ameriprise T-shirt or something like that, right?
Ugh.
And so but they knew me and we knew each other, right, on a casual basis, and they know what I do, and so. But it was just kind of an interesting, hey, what do you think about private equity?
I love that. How to start a conversation.
Right. Right.
That's cool.
Yeah. How to make friends and influence people.
Yep.
So anyhow, so I it depends is the obvious answer. And so I just tried to ask a few more questions, and lo and behold, they don't have any real investments. They have significant net worth, significant cash, significant available assets to do investing, but they've never invested really to speak of.
Yeah.
And so I said, well, for your very first investment, that's kind of an interesting question, that you'd go right to one of the most complex instruments, short of insurance, to invest in. It's extremely complex. And that's where you're going first. And that just doesn't necessarily make sense in my mind, to go to the most complex right out of the gate.
But that might be what their friends are doing or something.
But they have a friend, right,
Yeah.
that's been a friend of the family for a long time, that came up to him and said, hey, I've got this opportunity. I've got this opportunity, and you too can participate in this opportunity.
Yeah.
Have you ever heard that before?
This never ends well.
Yeah.
No, sometimes it ends great.
Rarely does this
but
end
that is
well.
a red flag, right?
And it happens all the time, right? To where somebody comes up and they present a business opportunity, whether it's helping them start up a business, whether it's investing in a business that's already existing and may have revenue or may have some potential at different stages in that place. But it is extremely complex. And so it was just interesting to go through that. And this is somebody with significant net worth, right? Millions of dollars of net worth and investability. And they're like, should I put $10,000 into it? And can they afford to lose $10,000? Probably, right? They can probably afford to lose. So should they try it? I don't know. Maybe not, right? But maybe it's a good investment. Maybe it's not. But rarely do these end out well when it's presented to you in that way, and you're not presented with official offering documents and things like that go down that path. And so normally for your first investment, you're going to want to build out an investment portfolio. And so we talk about the three pillars of wealth, and the three pillars of wealth, just as a reminder for those that are catching a podcast for the first time, is the financial markets, real estate, and owning your own business. And so typically when people are coming to us with new money, generally we're the second prong, typically, meaning that they've owned real estate or they own their own business and now they have cash and they're trying to get that invested somewhere. And so typically we're trying to build out something that will match their goals and keep it liquid, because they want to be in a position that if they have another business opportunity, they can expand their business. Or if they have another real estate opportunity, they can expand that they already know to some extent. And so if all of a sudden you put it in something that's illiquid, that has high fees, high exit charges, things like that, and they need it for one of these other projects, it's not there. It's not available. And so it doesn't really mesh with what their true core investment and financial values are. And we want things to mesh. We want your core values to be in alignment with how to build your wealth. And that's not going to be the same as your neighbors or your brothers or your sisters or whoever. It's your own story. And we want to help you with your own financial story.
Okay. So that's definitely when you should call a professional.
You should absolutely call a professional and have them walk through. And if you're getting presented, an investment idea like that, you absolutely should be vetting that through an investment professional and say, is this really appropriate for me? And keep in mind that when you do that, good data in, good data out, bad data in, bad data out, right? Meaning that you have to be forthcoming with that investment professional. You can't hold back 90% of your financial situation and expect a good, solid answer out of that. And so make sure that you're working with somebody that you trust and somebody that you have that you're building a relationship with, so that you can be forthcoming and you can disclose everything that's out there, so that you get good, solid investment advice out.
Very good. Okay. So speaking of using a professional, can you use a professional to start? What's the minimum amount maybe? And then, we've talked about definitely if you've got 500 to $1 million, you should be using a professional.
Yeah, so you can absolutely use a professional to start. Every investment advisor and every team will have their own set of minimums, typically. And so normally that's not firm driven, typically. And so when you look at the big investment firms out there, whether it's, Merrill Lynch, Ameriprise, Morgan Stanley, Wells Fargo, or some of the hybrid firms like LPL and Raymond James or Edward Jones, all of them will let the advisor within reason pick and choose who they want to work with.
Interesting.
But that advisor will typically set their own minimum. I know a lot of advisors that have $1 million minimum, a lot that have $500,000 minimum, some that don't have a minimum. And so you just have to kind of find that meshes. And so normally for our team, we're looking to work with people that have, $500,000 to $2 million. That's not to say that we won't work with somebody that's just starting out that has $5,000 or $50,000 or something like that, if they're savers and they're good communicators, and there's potential that they're going to grow, throughout their lifetime. Because we want to work with, there's a couple of traits that we want to work with, right? We want to work with good people. Life's too short to work with people that aren't good. We want to work with people that shape communities, that are involved in their communities, that are giving back to their communities and building their communities. We love to work with business owners just because their situations are sometimes more challenging, and we enjoy a good challenge as far as, things are concerned financially. And so we're looking for those types of individuals to work with. And if you're just starting that out, that's okay. We'll recognize that. And that may be a good fit for you. And if you've started out 30 years ago and you're just getting around to this leg of the stool, it may be a good fit too, right? And so either of those, we can have that conversation.
I like that's a great idea, looking for traits versus money.
Yeah.
When did you move towards that, or have you always been like that?
So I've always had that belief, just because, well, I shouldn't say always, but probably about after the first year of my career, right? Maybe a year and a half, is I'd had somebody come in that had significant amount of money, but boy, it just didn't feel good. And so every time they called, I was like, oh, should I pick it up? Should I not pick it up?
Yeah.
Do I want to talk to them? I don't really want to talk to them. They're just kind of mean and belligerent, and they're always trying to dodge things, and it just doesn't feel good. And so then I just made up my mind. Look, life's just too short, and in all of our businesses, right? I mean, whether it's in your business of podcasting, my business of financial markets, somebody else's business of real estate, you want to work with people you like. You want to work with people that are good people and have similar core values to you, because that's who you want to surround yourself with.
I agree. I've had leads on production that I have not followed up on purpose, because I just was like, no, I don't think I want to work with that person. So.
Right. And that's okay. And so if anybody comes away with one thing from this other than invest with Plan with Baxter, it should be a good person.
Be a good person. Well, lastly, again, we're talking with Rex, planwithbaxter.com. If you do have questions, please visit their website, planwithbaxter.com. I'm sure there's an email and way to contact from there. But let's talk really big money, and that's be more than the $1 million. What kind of, what do you invest in? How do you invest if you have big money?
Yeah, so let's talk big money, where we're talking maybe 10, 20, 50 million, maybe 100 million, something like that somebody comes to us with. And so when we're dealing with big money, everybody still has the same tools, right? We still have stocks, bonds, and cash. But now it opens up additional opportunities when we start to deal with big money, to where we have private equity options, to, we have hedge funds, we have, managed futures and different types of hedge funds. There's, numerous different types of hedge funds out there, whether they're focused on mergers and acquisitions, whether they're focused on...
We should clarify, that wasn't murders and acquisitions.
Sorry.
Mergers. Yeah.
Yeah, let's do... Yeah, if you ever get peddled a murder and acquisition hedge fund,
run.
Don't do it.
Fair enough.
Yeah, but there's a lot of types out there. There's private equity that's on the verge of going public. There's private equity that's venture capital and just starting up. Angel investing. There's a lot of different levels to that and complexities that go along with that. And so you want to be careful how much of your portfolio, even at 50 million or 100 million, is tied up in illiquid assets versus liquid assets, because we still have goals that we're trying to finance and things that you're trying to do, whether it be in your community and you're trying to build something special, or whether it's your family and you're trying to build a legacy. And so we still want to work around those goals. Planning is critically important when we're dealing with big money. is to make sure that we're going through and mapping out exactly what we're trying to do, because most of the time you have lots of different entities involved. You may have multiple LLCs, you may have, different business entities, you may have real estate, you may have a lot of different pieces involved that you're trying to manage. And then the investment end is just kind of wrapping around that and filling in the gaps that you may have as far as exposure and growth and liquidity along those lines.
Interesting. All right. Anything else on how to invest, Rex?
Get started.
Start today.
Get started.
Now.
Start today.
Visit and do that by visiting planwithbaxter.com, where Rex just hangs out and looks for messages.
Almost. Yeah. So be aware. Planwithbaxter.com. You'll reach us, and somebody on our team will get back to you.
Awesome. I love that. If you found value in this podcast, you can consider supporting us at buymeacoffee.com/Banyan Media. Also, you can watch and subscribe to us on YouTube at Through the Pines. You can like our Facebook page, Pines Podcast, and our Instagram, also Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.